Okay, welcome back. We're still in Chapter 2, and we're going to take a look at a few more transactions to see how revenues and expenses affect our business. And you'll notice on this page of the study guide, I still have the equation property equals a financial interest. But I'm expanding it a little bit more now, so that now assets equals liabilities and owner's equity. That's the fundamental accounting equation. Assets are the properties that we own, and the people that have a financial interest in our business are the people we owe money to, which we list as liabilities, and the owner who has put her own money in the business as well. So I've added a few more accounts. So let's take a look. We still have cash, and I have the beginning balances from those last 6 transactions in here. Cash has a balance of $83,000. I've got a new account called Accounts Receivable. I've kind of shortened it to say AR. Accounts Receivable. These are accounts that we're going to be receiving. When a customer uses our services but doesn't pay us immediately with cash, they charge it, and they promise to pay us at a later date. And we keep track of all the money that customers owe us here in Accounts Receivable. We still have supplies worth $1,500, prepaid rent of $8,000, and equipment of $11,000. So those are our assets, the property that we own. We still have accounts payable that has a balance of $3,500. This is the money that we owe because we've charged some things. $3,500. The owner is still worth $100,000, Carolyn Wells Capital. And now what I've done is added revenues, a column for any revenue that we generate when we provide a service, when we provide our accounting expertise to customers, we record it in the revenue column. And any expenses that we incur, salaries, insurance, taxes, whatever, any expenses are recorded over here. Now there's one little glitch. When we add up the left side, still we do that like normal. When we add up the right side, we're going to add accounts payable, Carolyn Wells Capital, and the revenue accounts together and subtract out the expenses, because revenues increase what the owner's worth and expenses decrease what the owner's worth. So we're ready to do some more transactions, and the first one, if you want to follow along, is on page 30 in your textbook under the heading called Selling Services for Cash. And it says, during the month of December, Wells Consulting Services earned a total of $36,000 in revenue from clients who paid cash for accounting and bookkeeping services. And this involves several transactions throughout the month. So during the month, customers came in, we provided some accounting help to them, and we billed them. We charged them $36,000, and they wrote us a check right on the spot. So if we talk about what property or what asset or what accounts are affected here, we know that cash went up because customers paid us $36,000 in cash. So we're going to do a plus $36,000 under the cash column. And because this is revenue that we generated from customers, we're going to go over here to the revenue column and increase it by $36,000. Okay? And we're going to draw a big line across the page. And we're going to bring our totals down. And we had a balance in cash of $83,000, and customers just paid us $36,000 more. So now we have a total of $119,000 in the cash account. We don't have anything in accounts receivable yet. Supplies, we still have $1,500 worth of supplies on hand. We have $8,000 in the prepaid rent account. We have equipment with a value of $11,000. We still owe different vendors $3,500 for anything we've charged. The owner's still worth $100,000, and now we have revenue of $36,000. And if we add up the left side and add up the right side of our equation, we'll come out with $139,500 on both sides, and so we're in balance. And we're ready for our second transaction, and it can be found on page 30 at the bottom underneath the heading Selling Services on Credit. Wells Consulting Services has some charge account clients. These clients are allowed 30 days to pay. Amounts owed by these clients are known as accounts receivable. If you think about it, these are accounts that we're going to be receiving. This is money we're going to be receiving from our customers. It's a new form of asset for our company. Okay, during December, Wells Consulting Services earned $11,000 worth of revenue from charge account clients. And these are customers who have come in, provided a service, but they didn't write us a check. They promised to pay us within 30 days. So what we're going to do is we're going to go over here to the revenue column, and we're going to put in a plus 11,000 in the revenue column, because we know we generated $11,000 more in revenue. Now, the customers didn't pay us cash, but they promised to pay us. So what we're going to do is keep track of that in the accounts receivable account. So we're going to say plus 11,000 in accounts receivable. It always sits right with the cash account because it's similar to cash, but the customers just haven't paid us the cash yet. So it's going to convert to cash very soon. All right, we're going to draw a line across the page and bring our totals down. We have $119,000 in cash. We now have $11,000 in accounts receivable. These are monies that customers owe us. $1,500 in supplies. $8,000 in prepaid rent. $11,000 in equipment. $3,500 in accounts payable. $100,000 in capital. And now we have revenue of $47,000. Again, if we add the left side, add up the right side, we'll be in balance. And we're ready for our third transaction, which is on page 31 under the heading Collecting Receivables. During December, Wells Consulting Services received $6,000 on account from clients who owed money for services that were previously billed. Okay, we've already billed the customer, and so we've already recorded that in the revenue column when we provided the service. But now the customers who owe us money are just sending in their money, sending in their check. And they're paying $6,000 on their bill. So we know that cash is going to go up $6,000. But we know accounts receivable is going to go down $6,000. Because accounts receivable is where we keep track of what the customer owes. They owed us $11,000, and now they're just sending in their check to pay on their bill, which reduces it by $6,000. So we're going to draw a line across the page, and we're going to bring our totals down. $119,000 plus $6,000 is $125,000. The customers did owe us $11,000, but now they've paid $6,000, so now they only owe us $5,000. $1,500 in supplies, $8,000 in prepaid rent, $11,000 in equipment, $3,500 in accounts payable, $100,000 in capital, and $47,000 in revenue. All right. We're ready for the fourth transaction, which can be found on page 32. We're back to the red-gray bars. In December, Wells Consulting Services paid $8,000 in salaries for the accounting clerk and Carlos Valdez. Okay. $8,000 we paid in salaries. So when we write checks for salaries, that's going to reduce the cash account. So we're going to put a minus $8,000 in the cash column. And we're going to put a minus $8,000 way over here in the expense column. Now, expense went up $8,000, but the reason I'm putting a minus sign there is because expenses decrease the owner's capital account. And when we add and subtract across, we have to subtract out the expenses. So I'm going to draw a line across the page. And I'm going to bring down my totals. I had $125,000 in cash, and I just wrote a check for $8,000 for salaries. So now I'm back to $117,000 in cash, $5,000 in accounts receivable, $1,500 in supplies, $8,000 in prepaid rent, $11,000 in equipment, $3,500 in accounts payable, $100,000 in capital, $47,000 in revenue, and I'm going to put a minus $8,000 there in expenses. So now we can add up the left side of our equation, and we should come up with $142,500 on the left side for assets. And when we add up the right side, we're going to take $3,500 plus $100,000 plus $47,000 minus $8,000. We're going to subtract our expenses, and we'll end up with $142,500. We'll still be in balance. All right, we're ready for our fifth transaction, and that's under the red gray bar on at the bottom of page 32. It says Wells Consulting Services issued a check for $650 to pay the utility bill. Okay, the bill came in, we wrote a check, so that's going to reduce our cash account by $650. And because it's a bill, an expense of the business, we're going to put a minus $650 over in the expense column. And we're going to bring our totals down. So we started with $117,000 in cash. We wrote a check for $650, so we're going to have $116,350 left in the cash column, $5,000 in accounts receivable, $1,500 in supplies, $8,000 in prepaid rent, $11,000 in equipment, $3,500 in accounts payable, $100,000 in a capital account, $47,000 in the revenue account, and okay, expenses, we're going to add those two expenses together. We had $8,000 in salaries and $650 in utilities. Together our expenses totaled $8,650, but when we add and subtract across, we're going to subtract those out so our equation stays in balance. All right, the last transaction is on page 33, above and below the red gray bar. Basically, Carolyn Wells wrote a check to withdraw $5,000 cash for personal use, and usually a sole proprietor doesn't put themselves on salary, but when they need money, they just take money out of the business. So she wrote a check to herself for $5,000, taking that money out of the business. What we're going to do is put a minus $5,000 under the cash column because she took money out of the business. And we're also going to put a minus $5,000 under the capital account because she's just taken the money out. And we're going to draw a line and bring down our totals. So $116,350 to start with in cash, minus the $5,000 check she wrote, and that gives us $111,350 left in the cash account. We still have $5,000 worth of accounts receivable. That's money our customers owe us for services that we've provided. $1,500 for supplies, $8,000 for prepaid rent, $11,000 for equipment, $3,500 for accounts payable. For the capital account, she started with $100,000 and $5,000 is taken out, so now she's worth $95,000. That's how much she's got invested in the business. And revenues, $47,000, and expenses, $8,650. Now, if we were to add up the left side of the equation, our assets, and then add up the right side of the equation, our liability and owner's equity, we would come up with a balance of $136,850 on both sides, and we'd be in balance. So that's how we record transactions using revenues and expenses.